Let's talk more about the markets now with Megan Horneman, Chief Investment Officer at Verdence Capital Advisors. Megan, how did you view the developments of the last couple of weeks? And I'm referencing some of the flux in the banking sector. Is it positive because the Fed at least has that on its radar and maybe is not quite as hawkish? Or does it portend maybe a deeper or a harder landing than we thought before? Net, what does it mean for stocks?
Yeah, I definitely wouldn't say it's a positive because I think it's just put the Fed in a more difficult position. Now they have to weigh the fact that we still are above the inflation target that they want, but yet they have to balance that with keeping stability in the banking sector. Short term, I think that some of the banking stuff may be behind us, but longer term, this is a growth issue. So I think that when you look at the stock market, I think the stock, what you've seen over the past 3 weeks, is getting a little bit complacent on what we can see for the rest of this year, as we start to see the banking crisis filter into economic growth.
Right. If there's a credit contraction, maybe earnings estimates still haven't come down enough, and that could introduce, I guess, some risk to where stock prices are. But then I can argue this. I can argue that maybe one of the reasons that technology has been outperforming is because rates might not go up as much, and therefore what you lose in earnings you might gain in not having multiples contract as much. Why do you think technology has been outperforming for the past month?
You mentioned it. Interest rates are lower, and the expectations, even if the Fed goes another 25 basis points, which we still believe that they need to and that they will, their market's pricing in rate cuts as early as the second half of this year. I think that's way too optimistic considering where we are from an inflation standpoint. That's why tech's rallying, and we've seen these spurts in technology over the past year. When interest rates decline, these large cap tech, mega cap tech stocks go up, and then you do see that kind of lose its luster when people start to get a little bit more realistic where the Fed can go and where they will go.
So inflation is going to stay stubborn, and the Fed is, they don't want to make another mistake in terms of underestimating something like they underestimated inflation. So they probably are going to be very hesitant to not get the job done here. What does all this say to you then about the averages? That they stay in a trading range, or do they go to new lows?
I think in the near term, and I'm not saying over the next couple days, I mean, remember, it's month end, there's a lot of things going on, but I think in the near term, the direction for stocks is lower. I think at least a 10% correction from here is probably likely. And then I think what we can see is after the Fed gets past that last rate hike in May, they're going to be on pause for a long time. We get through this banking crisis. We will start to absorb some of the downside from an economic growth standpoint, but we will be looking at what could be a very nice bull market coming out of this once we start to see inflation come down as well.